Crypto lender BlockFi files for bankruptcy. Crypto lender BlockFi has also declared bankruptcy on November the 28th, citing exposure to FTX's demise. BlockFi filed for Chapter 11 bankruptcy protection, becoming the latest market casualty following the firm's exposure to the dramatic collapse of the FTX exchange earlier this month. The filing in a New Jersey court comes at a time when cryptocurrency values have been in freefall. The price of Bitcoin, the most popular digital currency, has dropped by more than 70% from its high in 2021. BlockFi's Chapter 11 bankruptcy highlights considerable asset contagion risks connected with the crypto ecosystem, stated Fitch Ratings Senior Director Mansour Hussain. So what's behind this bankruptcy? What does it mean for crypto, and how can you keep your crypto safe? Keep watching this video as we review all of this and more. So, what's behind BlockFi's bankruptcy? BlockFi, a company based in New Jersey and founded by fintech executive turned crypto entrepreneur Zach Prince, stated in a bankruptcy filing that its significant exposure to FTX caused a liquidity issue. FTX, created by Sam Bankman-Fried, filed for bankruptcy in the United States early in November after investors withdrew $6 billion from the exchange in 3 days, and their first rival, Binance, dropped a rescue proposal, then later withdrew that proposal, which led FTX to file for bankruptcy as a final solution. Although the debtor's exposure to FTX is a primary reason for this bankruptcy filing, the borrowers do not encounter the troubles that FTX does, said Mark Renzi, managing director of Berkeley Research Group, BlockFi's financial advisor. Quite the contrary, he says. The liquidity issue, according to BlockFi, was caused by the exposure to FTX through loans to Almada Research, a crypto trading business linked with FTX. Cryptocurrencies held on FTX's platform were suddenly locked there. BlockFi's assets and liabilities were somewhere between $1 billion and $10 billion. BlockFi tells the U.S. bankruptcy court it's the antithesis of FTX. Lawyers representing BlockFi, the first direct victim of the collapse of FTX, appeared in U.S. bankruptcy court on Tuesday, highlighting that the U.S. cryptocurrency lender was the opposite of FTX. According to BlockFi attorney Joshua Sussberg, the company's collapse was triggered by its considerable exposure to FTX. In July, FTX provided a $400 million lifeline to BlockFi. Nonetheless, the Bahamas-based exchange fell dramatically, raising worries of industry contagion only days after BlockFi requested new funding on November the 8th. Sussberg went out of his way to separate BlockFi from FTX, claiming that the company did not encounter the same problems that FTX had. While FTX's new CEO has described efforts to locate lost funds and a complete failure of corporate controls, Sussberg claims that BlockFi has mature and consistent leadership, has hired the relevant specialists, and has established the necessary procedures and protocols. This is a very different scenario, Sussberg stated before providing U.S. bankruptcy judge Michael Kaplan with an outline of the crypto ecosystem and BlockFi's history. When BlockFi filed for Chapter 11 bankruptcy, it requested Kaplan's permission to continue paying employees, maintain bank accounts, and took other steps necessary to keep its businesses running during the bankruptcy process. Sussberg also stated that BlockFi wants to seek court judgment, allowing clients in the BlockFi wallet program to withdraw their assets during the bankruptcy proceedings if they so prefer. If it's in your wallet, it stays in your wallet, Sussberg said. The wallet program at BlockFi was developed in response to a regulatory investigation into the company's interest-bearing accounts, which the Securities and Exchange Commission found were unregistered securities offerings. To address the investigations, BlockFi ceased selling interest-bearing accounts to U.S. users, launched the wallet program for new U.S. consumers, and agreed to pay a record $100 million fine. BlockFi halted withdrawals from its platform earlier in November due to concerns about the stability of FTX. In a court statement on Monday, BlockFi stated that the company owed money to over 100,000 creditors. It cited FTX as its second-largest creditor, with a debt of $275 million due earlier this year. Ancora Trust is BlockFi's largest creditor, owing $729 million. Furthermore, it still owes the SEC $30 million from the fines it agreed to pay earlier this year. And Valar Ventures, a venture capital fund affiliated with Peter Thiel, holds 19% of BlockFi's equity shares. BlockFi's assets and liabilities were worth between $1 billion and $10 billion. The business sold a part of its crypto assets to fund its bankruptcy earlier in November, and it entered bankruptcy with more than $250 million in cash in hand. Celsius Network and Voyager Digital, two of BlockFi's main competitors, filed for bankruptcy in July, blaming unfavorable market conditions that caused losses at both firms. BlockFi admitted that it had suffered during the period of instability, but that the FTX loan had kept it viable while its competitors went bankrupt. BlockFi has offered a first restructuring plan that includes two exit strategies from bankruptcy. Its Chapter 11 strategy calls for BlockFi wallet clients to be fully compensated. Other account holders and creditors would be compensated with a mix of cryptocurrencies, cash, and new equity shares. The strategy also includes the possibility of selling the firm. How can you make sure that your crypto is safe? This can be a challenge for many cryptocurrency investors, as most crypto wallets are online, making them vulnerable to crypto attacks. But thanks to hardware wallets, investors can use a more secure method for storing digital assets. For example, a hardware wallet like Trezor allows investors to generate and isolate the keys to their cryptocurrencies in a way that keeps them out of the wrong hands and eyes. Trezor is a reliable wallet for storing your cryptocurrency assets. In addition, the crypto wallet is well known for its security, which makes it no wonder why over 1 million crypto users across the globe are leveraging Trezor to keep their coins safe. Trezor is a hardware wallet, a physical USB-connected device that offers secure cold storage that allows you to store your crypto assets offline. Although you must connect the device to your computer by USB to buy and sell crypto, the wallet is never connected to an internet server. Therefore, a hacker can't access your funds. Thank you for taking the time to watch. If you've enjoyed this video, don't forget to smash the like button and subscribe to be the first to get future blockchain, crypto, Web3, and NFT updates and news.